Property experts predict a housing crash. Let's have a look. Hello everyone, Florian.heise here. I have my morning stein of coffee, and I thought we'd start the day by having a look at this news.com.au article prepared by James Hall discussing, well, more expert predictions of a housing crash. Now, before we go through this article, let's just jump over to the Property Council data room. And we can see here, I brought up the median value of residential houses based on CoreLogic's automated valuation model. Now, this data is from the 31st of March, and if one trusts it or not, that's really not beside the point. But we can argue that a lot of real estate agents use this as gospel, believe it to be 100% accurate, particularly when they tell you what you can get for your property. We can see the median price in Sydney is $925,000. Melbourne is $727,000. Canberra is $685,000. The average, the weighted average, is $675,000. Brisbane, we're at $540,000. Hobart at $500,000. Perth at $475,000. Darwin at $466,000. And Adelaide is down to $460,000. Now, keep these numbers in mind. Just every time we read all these articles, we read something from Domain where they're talking up the market. You know, a house sold at $200,000 above reserve, and it's like a $4 million apartment or something, or a $2 million house in Melbourne. Yeah, and you can just say by looking at this, well, okay, that's not the median. It's not a specky. It's not what most average punters will go to, but that seems to be how they're crafting a narrative and how they're getting clicks, you know. Because there's a lot of people that want to see positive news about property. Because, you know, I'm going to tell you a secret, everyone. I'll tell you a little secret. Australians have a little obsession with property. Just a little. You know, we just have every single bloody TV show is about property. Every home reality show is about property. Big chunk of the investment of our civilization is in property. It's in property. You know, rent money is dead money. Housing always goes up. So let's have a look at this. Let us have a look at this. The housing market. ANU report reveals grim sign for house prices. The grim sign for house prices. And we're looking at a reference from a previous video because I've misclicked. So, an alarming study has revealed the incredible stress Australians are suffering through to try and afford rent and mortgage each week. Now, here's what you have to understand. We've only just entered the beginning of this recession. Technically, we're not in one yet. And people are going, oh, we've been in depression since the GFC. Well, we've still been growing since the GFC. GDP has been growing since the GFC. The growth has been below trend on a per capita basis. So that means, you know, our growth, while growing, has been lower than the trend, than the average over the period of time. I took it back to the 70s, to when they first started counting growth per capita, when they did a per capita GDP growth, and we've been below that trend. And the trend's been going down. So quality of life is getting worse, everyone. You know, you're needing more and more people to keep that GDP number up, but everyone's slice of the pie is getting less and less. So, when they're saying now people are struggling to afford rent, when they're struggling to afford their mortgages, let's wait and see what happens when the recession, maybe we get 2 quarters of negative growth, when we're actually in a recession. Property experts are bracing for a sharp fall in house prices after a new report confirmed the pandemic crisis led to a number of Australians unable to pay their rent or mortgage on time, more than doubling. So, the last data we got from the RBA with regards to arrears rate, you could see how it's climbing from 2016 up to 2019. And let's just say, just for argument's sake, all of these numbers have doubled. So the rest of Australia is between 0.5 and 1%. So now we're over 1%. WA is at 1.5, it's at 3%. Queensland, we're nearly at 1, we'll be at 2. We'd be at 2. That isn't, you know, a large number of people. I understand that. But you've got to remember, with property prices, with these figures, the last property that sold in your street, the last property that sold in your neighborhood, the last property that sold in your postcode, that is what's going to affect the case of people's, affect the valuation of your house. That's what the real estate agent is going to refer to. Have you gotten the little flyers in your mailbox, from the local agent going, we've sold this for that much? That's what they base it on. So if you start seeing more and more people get desperate, maybe forced sales start to emerge. Maybe, they fall down from the job keeper because their business that they're working for has let them go. And maybe they're on to job seeker. And then that falls back down to only the 75 extra a week. What's going to happen then? Maybe people start getting forced sales. You've got people who are struggling to rent out their Airbnbs because tourism is gone. So this is the thing. This is why I'm being patient with everything. I think that's the best advice you could have when you're dealing with any of these things. It's just to be patient, take your time. If you've got your heart set on a property, there'll be another one. There will always be another one. Don't worry, they come up often. There's a lot of houses. Once you get your heart set on it, then you kind of, you can be manipulated emotionally. A survey from the Australian National University revealed those who are unable to service regular housing costs surged from 6.9% to 15.1% from April to May. So that's terrible. That's much worse. So this is just regular housing costs. So it's not just mortgages. I guess rent as well. 15% of people who answer the survey. It's well documented. Younger generations are more vulnerable to economic shocks, and this demographic is suffering as the nation slides into its first recession in nearly 30 years. I was talking with Rachel about this, the difference in the generations. And she mentioned there's this argument that if you don't achieve what your parents did at their same ages, you generally are unhappier. And, one example, just from my own living memory, for Rachel and I to become an architect, we had to do 2 degrees. We had to do a Bachelor of Architecture a Bachelor of Built Environment, then a Bachelor of Architecture. We needed 2 degrees. The seniors that worked before her in the practice, they only needed a diploma of architecture. So that was to decree inflation. And now the new people going to become an architect need a Bachelor of Architecture and a Master's of Architecture. You're thinking, Florian, they must be getting so much more for their master's degree. They're not. But you know what they're getting? They're getting a higher HEX bill because it's a master's. More expensive. Right there's an example of inflation in my own profession. And you think the wages or revenue of the profession has gone up to compensate for that additional cost that the younger generation has to suffer through? No, it hasn't. It is not. So, that's another impediment, another hurdle. It really is. It's if you think about it, so it's a bit harder to reach those same time bars as it was for past generations. I mean, in particular, just the cost of housing. The cost of housing relative to wages. And that affects the affordability. And that affects how fast people can get into property. So it may take people 10 years longer than their parents. They may have to have both people working in a relationship before they can do it. They may be afraid to have children because they think they can't afford it. We'll have to see, everyone, what the next 5 years entails. What's worrying is that young adults are experiencing very high rates of housing stress, with 44% of people aged 18 to 24 unable to pay their rent on time, said co-author Professor Matthew Gray. And you're going to see more and more young people moving home. And even, young people, I'd say my age down, nearly 40 down. You'll have 30-year-olds moving home, back with their parents, with their older parents, just to save money. I mean, you can't blame people for doing it. It's the only way to get ahead, actually. We're planning, with the design of our house, we anticipate that, we'll have all the adult children coming back to save money to get into housing. That's what we're designing for when we're building underneath, so we can separate it into different areas. Young Australians are still more likely to be in housing stress once income and socioeconomic status is controlled for. suggesting that there is more to housing stress than just income for this group. This is because their accumulated savings and wealth is likely to be low. The rate of those aged 18 to 24 experience higher levels of housing stress. High levels of housing stress soared from 10.3% to 27.5% over the month. Nearly a third while those aged 35 to 44 suffered a threefold increase in housing stress from 5.9% to 19.1%. So my age bracket, we're doing a bit better than the youngies. Well, yeah, 10% better, really, a third better. Study co-author Professor Nicholas Biddle said the pandemic had clearly left a concerning number of young Aussies in incredible stress. And this is while they are also likely dealing with other major stresses in their lives, like the potential loss of income. And here's the thing, the challenge is, I said, why haven't people got a rainy day fund? Why don't they have 6 months cash stashed away? Well, I'd say two reasons. One is they don't even haven't been educated in that process at all. You don't get any financial literacy at school, not at university, unless you specifically do studies on that. And even then, it's questionable. But also, they'd be at lower income, they've got higher costs. How many of them are going to have to dip into maybe what they've scrolled away for a house deposit? The prevailing fear within the housing sector is a large number of Australians won't be able to service their loan, leading to an increase of stock forced onto the market as the nation falls into recession. This is a grim recipe for house values to fall sharply. I'm a little surprised with how they're recording mortgage stress, REA Group Director of Economic Research, Cameron Kusher, told News.com. There's a concern of what will happen come the end of September when JobKeeper and JobSeeker are removed and the mortgage holidays are also eased. And don't forget, directors' liability for trading while insolvent will also be reinstated then. We'll see what happens. I wonder if businesses will shut down in September. I wonder if we'll see a spike in bankruptcies. What do you reckon? But what we're hearing from particularly the banks is there's going to be a fairly pragmatic approach. And the fact borrowing costs are at the lowest they've ever been eases that risk a little. It's not like the last recession where interest rates were 20% and the banks had to shift mortgages off their books straight away. Mr. Kusher said the current record low interest rates will shield lenders from the need to call in a large number of its loans. But they can't extend these mortgage holidays forever. So there's definitely going to be some people in a position where they will have to sell, he said. That's why the government is so desperate to open as much of the economy as they can before September, because they know that all this stuff has a relatively short lifespan and they need to get people back working. A relatively short lifespan. Are people still hoping that we can bounce back from this? What about international tourism? What about international trade? What about the fact that nothing's manufactured in our nation? Australians under 30 have been more exposed to job losses throughout the virus crisis and are more likely to be renting than living in their own home. This generation, forced out of work, is expected to forfeit their lease and either move back in with parents or into significantly cheaper property, with next to no migrants entering the market and placing enormous pressure on the sector. Well, here's another thing. What about all these people that have invested in these properties, that are doing the negative gearing magic, that can't get renters, or rents forced to decline? Maybe they'll be forced to sell. What if they lose their work too? I suspect some people are being a little bit optimistic here. We will see an increase in vacancy rates, we will see some falls in rents, and I think it's going to take some time to recover, he told News.com.au. The flow-on effect is, what does that mean for property investors? Because if they have to reduce rent significantly, they may feel that it's better to sell that property and put it in the share market or other investments. In some ways, that might be a good thing. Freeing up capital out of the housing property sector and investing in other things that could perhaps add greater value to our nation. Maybe something innovative. We'll have to see. Hopefully hopefully the government, the unions, the businesses will all come together and remove some of the onerous burdens on entrepreneurs in this nation, so the governor of our Reserve Bank doesn't think we're all lazy. What do you think, everyone? Do you think housing prices will be affected, or will it all be rosy? Will the bank mortgage holidays save us all? And are you ready to jump right in, take all that government stimulus to jump on construction or buying new houses? Let me know what you think. Please like, share, and subscribe to the channel. If you're a fan and want to support us that bit extra, there are a few ways you can. You can join us on YouTube or Patreon. You can support us via using our affiliate links at Amazon or eBay or Independent Reserve and Kucoin. You can buy our merch from HeiseSays. I've got pocket squares you can see behind me, handmade by Rachel herself. You can use Gold Pass from the Perth Mint or support us via PayPal. Thanks, everyone. Have a great day.